Wall Street growing more and more divided over Netflix and the future of that streaming giant. The stock down nearly 70% this year, and investors are starting to ask the question Netflix asks every time you fall asleep on the couch after binging Stranger Things. Are you still watching? Some of the top issues on our watch list: subscriber losses, streaming competition, rising costs leading to layoffs, price hikes, adding an ad business, and takeover potential. Takeover? They were supposed to be the buyers of everything, not maybe a seller. We've got a classic bull-bear debate. Wedbush's Michael Pachter is our bull with an outperform of $280 on the price target, and Benchmark's Matthew Harrigan is our bear. He says sell. $157 price target. Michael Pachter, the longest guy running bear on Netflix, has changed his stripes. Why?
Mostly because I have integrity, and I actually think the stock's worth 280. So when it was trading at 600, it was a sell, and when it's trading at 190, it's a buy.
And did you think that your I'm not going to call them colleagues, but your fellow analysts who kept saying that the stock was going to keep running, obviously it did for a long, long time, and then it stopped. Are you saying that they are equally wrong now in thinking, like Matthew does, that it's going to go down, 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 down? In other words, the wisdom of crowds or the madness of crowds?
You know, I don't want to disparage Matthew, and I don't know what his thesis is, so we'll let him speak for himself. But I think on the way up, it's a tendency of the sell side to tell you what just happened and extrapolate and tell you why that's going to continue to happen. And on the way down, same thing. So, you know, I think these guys had a hiccup. I mean, clearly competition caught up with them. Clearly subscriber growth slowed. They're kind of a victim of an outdated model where they dump all the episodes at once. They're beginning to emulate the competition there. They're picking up ad support, so they're emulating the competition there. They're starting to cut costs. They're starting to focus on not making as many movies. So I think if they focus on the bottom line, they're going to deliver profit growth. And profit growth, maybe it's not worth 600, but it's worth 280.
All right, Matthew Harrigan, your turn. Hiccup or Heimlich?
Oh, I think it's probably more of a Heimlich. I think people have really approached this as a tech name, more or less a winner-takes-all outcome, or somewhat in that direction at least. And I really think it's a media name. We've been pretty agile in our ratings. I've had buys on this before. Unfortunately, I upgraded it from sell to neutral after Q4 came out, and then somewhat unfortunately, we upgraded or downgraded it again to sell from neutral fairly recently. But I think if you kind of apply, valuation parameters for media stocks, we're still assuming they get to, 350 million early in the next decade, mid 20% type margin. I think that's what the stock would be priced for if you ran a valuation all the way out to 2033, let's say. And at this market, you want sort of short-term success. You've got probably another big loss of subscribers, 2 million guidance in this quarter. I don't think the second half is going to be as robust as people would like. If you truncate the forecast, more toward 27, 28, that's where we get to our 157. And I don't think it's going to be easy to instill advertising business and cut down on the password sharing, et cetera.
Shepard Smith here. Thanks for watching CNBC on YouTube.